Before we begin, a quick disclaimer. This episode is for general education only. It is not financial, tax, or investment advice. Retirement planning is personal, and before making major decisions, you should talk to a qualified financial advisor who understands your full situation. So, let's talk about the big retirement question, right? How much money do I need before I can stop working? Now, it seems like a simple question, but when you actually sit down and think about it, it becomes surprisingly complicated. Because what are you really asking? You're asking how long you will live, you're asking what inflation will do over the next 30 to 40 years, you're asking what the stock market will do, you're asking whether your healthcare costs will go up, whether social security will be enough, whether your lifestyle will change, and whether your money will run out of before your life does, and all the travel that you want to do, right? So it's a scary thought. And that is exactly why one simple idea became so famous in retirement planning: the 4% rule. So, what is this 4% rule? The 4% rule tries to answer a very practical question. If I have a portfolio of stocks and bonds, how much can I withdraw every year without running out of money too soon? The basic idea is this: in the first year of retirement, you withdraw 4% of your portfolio. So if you have $1 million invested, you withdraw $40,000 in the first year. If you have $2 million invested, you withdraw $80,000 in the first year. But here's the part many people miss: the original 4% rule does not mean you withdraw 4% or whatever your portfolio is worth every year. It means you withdraw 4% in year one, then you increase that dollar amount every year for inflation. So let's start with 1 million and we withdraw $40,000 in year one. If inflation the next year is 3%, then you do not recalculate 4% of the new portfolio balance. Instead, you take last year's $40,000 and increase it by 3%. That gives you $41,200 in year two. The goal is not just to give you money, the goal is to preserve your purchasing power. In simple language, the rule is trying to help you keep the same lifestyle even as prices rise. Now, before we go any further, one clarification is important. The 4% rule is mainly about liquid portfolio of stocks and bonds. It was not created for rental properties, apartment syndications, private real estate funds, your primary home, business, etc., etc. So real estate can absolutely be part of someone's retirement plan, but it works differently because it has cash flow, debt, repairs, vacancies, taxes, and liquidity issues. So in this episode, when I say portfolio, just think of stock and bond portfolio, not total net worth. All right. So let's understand history a little bit, right? Where did this 4% rule come from? The 4% rule usually credited to William Bengen, uh, a financial planner who published research in 1994. He looked at historical uh, market data and asked a very practical question: what withdrawal rate would have survived the worst retirement periods in the modern American market history? He was not just looking at average returns, that is important. Averages can be misleading. If a stock market averages 8% or 10% over a long period, it is tempting to think, great, I can withdraw 5% or 6% and be fine. But retirement does not happen in averages. Retirement happens year by year. If the market crashes early in your retirement, the damage can be much worse than in the same crash happens later. Why? Because you're withdrawing money at the same time your portfolio is down. You are selling from weakened portfolio, and those shares are no longer there to participate in the recovery. Now, this particular phenomenon actually has a name. It's called the sequence of returns risk. It's a fancy phrase, but the idea is simple. The order of returns matters. Imagine two retirees both earn same average return over 30 years. One gets bad market returns at the beginning and the good returns later. The other gets good returns at the beginning and the bad returns later. Even if the average return is the same, their outcome can be very different because the first retiree had to withdraw money while the portfolio were already under stress. This is the problem Bengen was trying to solve. His conclusion was that the first year withdrawal of 4%, about 4%, followed by inflation adjustments, historically survived the difficult periods he tested for a 30-year retirement. A few years later, another study made this idea even more famous. It is commonly known as the Trinity study because it was done by professors from Trinity University. That study also looked at different withdrawal rates, different retirement lengths, and different stock and bond mixes. Over time, the 4% rule became one of the most quoted ideas in retirement planning. It became popular because it made retirement planning feel simple. Instead of saying, I need some large amount, unknown amount of money, people would say, let me estimate my annual expenses and multiply that by 25. And the simplicity is what gave this rule staying power. And then came the FIRE movement. FIRE stands for financial independence, retire early. The basic idea is that if you save aggressively, invest consistently, and keep your expenses under control, you may be able to reach financial independence much earlier than traditional retirement age. The FIRE movement loved the 4% rule because it turned financial independence into a simple formula. If you could withdraw 4% of your portfolio each year, then your target portfolio is roughly 25 times your annual expenses. This is because 4% is the 1/25th. So if the annual expense is about 60,000, the FIRE number is 1.5 million. If your annual expenses are 100,000, then your FIRE number is 2.5 million. That is powerful because it changes the question from how much money is enough to how much do I spend each year, at what number do I need to support that spending. This is why 4% rule became so closely linked to FIRE moment. It gave people a target. It made early retirement feel measurable. But there's a catch. The original research was mainly focused for a 30-year retirement. That makes sense for someone retiring around 60 or 65 and planning into their 90s. But many FIRE followers are trying to retire much earlier. They're trying to retire at 45, 40, or even younger. Now that changes the math. If you retire at 40, your money may need at least 50 more years or more. That is not the same problem as 30-year retirement. You have more years of inflation, more years of market uncertainty, more years of healthcare uncertainty, and more chances for something unexpected to happen. But does not mean FIRE is impossible. It usually means that the 4% rule blindly can be risky. Many early retirees build in flexibility. They might use a lower withdrawal rate, such as 3.5% or even lower. They may keep some part-time income. They may reduce spending during bad markets. They may have rental income. They may delay large purchases. They may eventually receive Social Security. They may simply choose to keep a bigger cushion. That flexibility is very important because real life is not a spreadsheet. So now the big question is, does a 4% rule still hold today? The honest answer is that it still works as a useful starting point, but it should not be treated like a law of nature. Now, recent retirement research has generally suggested that something close to 4% may still be reasonable for a traditional 30-year retirement. Now, depending on assumptions. Some research comes in slightly below 4%. Some research, especially when using more diversified portfolios or more flexible spending assumptions, may support numbers slightly above 4%. But the important point is this: safe withdrawal number is not a fixed forever. It changes based on market valuations, bond yields, inflation expectations, asset allocation, taxes, spending flexibility, life expectancy, and specific period in which someone retires. So when someone asks, is 4% still safe? The best answer probably is, it depends, but it's still a useful starting point. Now, why flexibility matters? Like one thing the newer research has emphasized is that flexible spending can make a retirement plan stronger. Think about how people behave in real life. Like if the market is down 25%, most retirees are not going to say, well, my spreadsheet guys says I should increase spending for inflation. So let's upgrade the vacation. Many people naturally adjust. They postpone the new car, they take a smaller trip, they delay a home project, they become more careful for a while. That flexibility can make a retirement plan more resilient. But there's another side to this. Some expenses are not flexible. Property taxes, insurance, utilities, groceries, medical costs, and basic living expenses do not disappear just because the market had a bad year. That is why retirees need to understand how much of their spending is essential and how much is discretionary. The 4% rule is more comfortable when the retiree has room to adjust. So, in a nutshell, the 4% rule is a useful starting point, not a guarantee. For a traditional retirement, it can still be a reasonable way to think about withdrawals from stock and bond portfolio. For early retirement, it is more caution because, or I can even say more cushion, because the money may need to last much longer. The real reason is simple. Retirement planning is not just about reaching one magic number. It is about knowing your spending, understanding your risk, and building enough flexibility so you can stay retired with confidence. Thank you very much for listening. My name is Vaibhav Puranik, and this is the OMC Real Estate Podcast. Our website is oldmoneycapital.com. Please go there and click on request a call button so that we can educate you on how multifamily syndications can play a role in your retirement. Our YouTube channel is Old Money Capital, and our Instagram handle is Old Money Capital 123. Thank you again.